Welcome back to URP 4741, Housing Policy and Planning, and URP 6742, Seminar in Housing. This lecture will cover housing finance and also taxes. First, I'm going to introduce the housing finance, especially related to the three stages. Housing finance and the New Deal in the 1930s, and then housing finance from the 1940s to the 1980s, and then housing finance up to the 1980s. They are very distinctive three stages because in the 1930s was mostly the policies responding to the Great Depression. Between 1940s and 1980s, the mortgages were mostly provided by the savings and loans institutions. And then after 1980s, the mortgage market had significant changes where the secondary mortgage market began to get established during that time period. So for the Housing Finance and New Deal, I'm going to talk about the home loan bank system and also a few other organizations which were established to help resolve the issues associated with the Great Depression, such as foreclosures and also some other issues, and also to expand their possibilities of home ownership. The first reform or the system is called a home loan bank system. Basically, that initiative strengthened the thrift system, which means the savings and loan systems. That means they act more like a bank, and then people would deposit the money into the savings and loans, and then the savings and loans would use the deposit to issue mortgages to home borrowers. And also, the system was established trying to respond to the foreclosure crisis, and it does provide some funds for mortgage lenders and also extended the mortgage terms, increased the maximum loan-to-value ratio. In the previous lecture about mortgage, you should understand the loan-to-value ratio means the percentage loans can be borrowed when you compare to the housing price, purchase price. So before the home loan bank system, usually the mortgage term was really short, like 5 to 10 years, and then they extended the mortgage terms to 15 years and also increased the maximum loan-to-value ratio. In that way, the borrowers can lower their payment and also can easier for them to get a mortgage. It did not really help much with the foreclosure crisis. So that means later on the federal government decided to have some other reforms and initiatives trying to solve the issues of the foreclosure crisis. This is like from one of their initiatives was the Homeowners Loan Corporation. This further extended mortgage terms to 15 years, purchase refinance mortgage loans in default. That means the borrowers were behind in the mortgage payment. Those mortgages were purchased, and then they actually managed to refinance those mortgage loans for those who were in default. Their purpose is trying to pull people out of foreclosure. And also, the initiative provided funds to homeowners to pay taxes and home repairs. In that way, they can release some extra funding to pay for the mortgages. And also, another initiative is to provide low interest loans to some homeowners in order to buy back their homes, which were lost to foreclosure. In 1934, the Federal Housing Administration, which is FHA, was created through the National Housing Act of 1934, and that further extended the mortgage terms to 25 to 30 years. So that's great news, so that people don't have to pay so much for their monthly payment, and also increase maximum loan-to-value ratio to 93%. Furthermore, later on, the FHA insured loans, sometimes you don't really have to pay much, like a very large amount of down payment. And also established for minimum standards for housing construction quality so that people don't have to live in substandard housing, and also bailed out mortgage lenders from the risks from the borrower default and foreclosure. And insured mortgages issued by qualified lenders. So that means if the borrowers default, the risks will be transferred to FHA. And then the FHA will take back the property and sell the property. In that way, the lenders do not have to bear with the risks of borrower default, which means borrower not being able to pay back the mortgages. However, FHA has helped tremendously to increase the homeownership rate across the United States. However, FHA has redlining and racial discrimination in their standards. Like when you apply for a mortgage, they actually incorporated race and some other demographic variables into the qualification approval process, and prohibiting certain borrowers from certain areas, the redlined areas, to get a mortgage, FHA mortgage. So the practice was outlawed after the 1960s civil rights movement, but still the profound impact of the redlining and also racial discrimination from the FHA insured mortgages have created long-lasting problems in a lot of like inner city neighborhoods, because those neighborhoods were redlined. That means people were not able to get mortgages and stuff. They did not have sufficient credit access, which created a lot of issues, and also which influenced the homeownership rate gap between white and minority homeowners. Federal Housing National Mortgage Association, first called FNMA, later on it's just renamed as Fannie Mae. And I'm going to mention Fannie Mae is one of the major players in the secondary mortgage market. That means Fannie Mae would purchase the mortgages generated by a financial institution and then sell the mortgages to investors, like treat it more like a security, like a stock or mutual funds. And Fannie Mae played a very important roles in the housing market and housing finance in the United States, making homeownership much easier for a lot of people to get. So it was established in 1938, and first only focused on FHA insured mortgages to purchase those, but later on expanded to purchase other types of mortgages, like in the conventional mortgage market. And later, I'm going to mention later on the Ginnie Mae mostly was responsible for purchasing FHA insured mortgages and VA insured mortgages. But Fannie Mae expanded its roles to purchase mortgages from conventional markets. Mortgage finance from 1940s and 1980s mostly rely on the thrifts, which means the savings and loans banks. That means the deposits. However, over in the 1970s, the savings and loans began to really not be able to compete with the emerging mortgage markets, and also because of the rising interest rates, it's very hard for the savings and loans to break even, because they have to pay very high interest rates for the savings deposits, but meanwhile they lose money to issue mortgages to the home buyers. And also the demand, high demand of mortgages loans far exceeded the deposits. So that means it's not sustainable. And what do we do? The Financial Institutions Reform, Recovery, and Enforcement Act of 1989 basically bailed out the failing savings and loan system. And also the shares of mortgages generated by the savings and loan systems was decreased drastically over time. And in the after the 1980s, pretty much made its role, actually transferred its role to the secondary mortgage market, and that means it has very diminishing roles in generating mortgages since after the 1980s. And from this chart, you can see the thrift share of total mortgage holdings just declines further and further. Now it's a very, very small portion. It's maybe less than 10% now is covered actually by the thrifts, the mortgages. However, the total value of thrift mortgage holdings also kind of decreased, but not as much as the share. The housing finance from the 1990s to the present mostly indicating the rising and also the dominance of the secondary mortgage market, which means that once the mortgage is generated, it's quickly sold to the secondary mortgage market, bundled together and converted into securities like stocks, mutual funds, and sold to the secondary market investors, and also the government-sponsored enterprises, which are Fannie Mae and Freddie Mac, and the Ginnie Mae. Ginnie Mae is actually a government agency, but sometimes we treat it as a government-sponsored enterprise. And also private label securitization, and also not just the three government-sponsored enterprises purchased mortgages, but also the private market also purchased the private label securitization of the mortgages. And also the mortgage pricing since the 1980s mostly were based on the risks, default risks. And default risks mostly relate to like the income, stable income, and the credit scores. And during that time period, also subprime lending became one of the component of the mortgage market. Later, actually, some of them subprime lending means the interest rate was much higher than the prime mortgages to be issued to those people who don't maybe have a high credit score or who don't have a stable income, but they were charged higher interests. And then the default risks for subprime lending is much higher than prime lending. And also one extreme of the subprime lending is called predatory mortgages. Predatory mortgages means their interest rates were really high and reaching the point of predatory. And then there's another type of mortgages called Alt A loans, which is between the subprime and the prime loans. That means the interest rate is not too high, not too low, and usually issued to the borrowers who maybe have sufficient credit score but may not have stable income, or may have stable income but did not have very sufficient credit scores. During that time period, however, along with the subprime lending, there were many other types of mortgages were issued in a way to make it so easy for the borrowers to get a mortgage. And we actually call that as green lining. Remember, the red lining means areas were redlined, borrowers from redlined areas were not easy to get a mortgage. But now, during this time period, they made pretty much everybody can easily get a mortgage. And the outcome is, you make everybody get a mortgage even though they cannot afford to have a mortgage. And then when situations change, they have a payment shock. Like for example, if they have adjustable rate mortgage or teaser rate, they get a payment suddenly increased. Or you pay the interest first, but then you have to pay the principals suddenly. Or you just have a balloon, like large amount of payment after a certain time period. And also some other like payment option, you can make some options when you pay. And also some incomes are not verified and you still get a mortgage. So under those situations, a lot of people were not able to maintain their mortgage crisis, especially when this is associated with the housing boom in the early 2000, like between 2000 and 2006. In that case, the housing price was really high. They get a mortgage they could not afford. And then suddenly, they just couldn't pay. And then the mortgage crisis started in 2007 and 2009. So basically, the mortgage crisis was one of the leading factors contributing to the most recent Great Recession, in the beginning of the recession. But later on, with the procession of the recession, many people lost jobs, and then unemployment became a leading factor for the recession between 2007 and 2009. And so after 2009, there were a lot of reforms and some other things going on trying to resolve the issue of the mortgage crisis. And then later on, the market slowly began to recover until recently the housing price became much, much higher. And then there were concerns about the potential cooling down of the housing market in next year or next 2 years. And, some people even worry about a potential recession on the way because of the economic cycle theory, unless the demand for housing keeps strong in the next 2 or 3 years. Okay, so the government-sponsored enterprises, they have pretty strict requirements about which kind of mortgages they like to purchase, and they call them conforming loans. And the non-conforming loans, they usually don't purchase, or they require certain conditions to purchase them. So I mentioned Ginnie Mae mostly purchases FHA and VA insured loans. Freddie Mac and Fannie Mae mostly conventional mortgages, which means they're private market mortgages. And borrowers need to have a steady income. And a mortgage payment cannot exceed a specified percentage of income, like for example, 30%. And also conventional mortgages with a loan-to-value ratio higher than 80, that means the down payment lower than 20%, they need to purchase a mortgage insurance. And also has restrictions about the maximum amount of mortgages that each house has. So those are the conforming loans sold to the GSE because they want to lower their risks. And after the 1980s, the securitization of the mortgages became so widespread and just keeps increasing. And you can see that the government-sponsored enterprises and FHA, which means they actually separate Fannie Mae, Freddie Mac, and Ginnie Mae. So you can see the securitization kind of very high during the boom years, but then kind of slowed down and then kind of got a little bit stable. For the private label also has a period pretty high and then began to kind of go more like stable. And during this time period, the GSE had to be bailed out by the federal government because Fannie Mae was having so much trouble because a lot of people couldn't pay their mortgages during the recession. So that means, they had to bear a lot of losses. During that time period, the federal government had to take over Fannie Mae and Freddie Mac, trying to restructure and make sure everything will be good until later on. And this is just a little kind of trend about the mortgage foreclosures. and mostly it's during the recession, but later on becomes much lower. So you can see that the mortgage foreclosure mostly during the recession and slowed down after the recession, like 2010 and 13. But the repo effect lasted for quite a while, maybe up to like 2013, all the way from 2007 to 2013, and then began to decrease drastically. So that means many fewer people foreclosed for their mortgages. Their multifamily financing struggled quite a bit. The growth of the secondary mortgage market really made it limited availability for debt financing for the rental housing. So that means the funding for multifamily housing has declined since the 1980s and 70s. And they have much less access to mortgage financing with the best terms compared to single family home buyer borrowers. Okay, so we talk about all those housing finance measures and policies and stuff. Basically, public policies played a very instrumental roles in the housing finance, in a way of stabilizing the housing market, stimulating home ownership, and also providing decent and high quality housing and stuff like that. So basically, the public policy is through their different legislation. And there are a lot of national housing acts over the years, 1934, 1949, 1954, and then later on the housing acts. And also offers incentives, bailout schemes, such as after Great Recession, the federal funding was available to bail out the foreclosed borrowers. And 2020, during the COVID crisis, the CARES Act was able to also help homeowners and renters not to go foreclosure or get evicted. And so that means federal government played very important roles in securing housing stability of regular homeowners and home buyers, and also for sure provided a lot of incentives to build affordable housing. Later I'm going to mention low-income housing tax credit, which is one of the major and leading programs providing affordable housing for low-income households. Another notable act is called the Community Reinvestment Act, and that made sure the accessibility of credits was available even in those inner city low income areas, and we will talk about this later on. And it was established in 1977. And also the government-sponsored enterprises provided important roles and played critical roles in providing home mortgages. And later on, 1975, the Home Mortgage Disclosure Act prohibited discrimination against borrowers based on age, gender, nationality, ethnicity, race, and many protected categories. So that means that financial institutions and mortgage lenders, they are required to report to the federal government about the borrowers' demographics, so that they will be scrutinized if they have any discrimination against certain borrowers. Okay, I'm going to just briefly talk about taxes, housing and taxes. There are multifold of federal tax expenditures in housing. First is homeowner tax expenditure. So all the incentives, the deductions, and stuff like that, they are the tax expenditures by the federal government because they lost taxes, right? They have to give you back because you have a house or you have mortgage interest. And also the investor tax expenditure. Investor tax expenditure also could include like tax credits as well. Like for example, the low-income housing tax credit, which means developers can get tax credits, then they can sell those credits to the private entities, and then they can use the money to build affordable housing. So for the tax expenditure in housing, but mostly deductions, I don't know if you have heard of that. If you put, like for example, if you're a homeowner, you pay mortgage interest, you pay mortgage insurance, you pay property tax, you pay mortgage points sometimes, and then in that case, you can get tax deduction. For example, if you paid $10,000 in mortgage interest last year, when you file the tax return, you can reduce your taxable income liability by $10,000. Like for example, if your taxable income is $100,000 and your mortgage interest is $10,000, that means that you only have the taxable income will reduce to $90,000. So that's the deduction. Deduction directly reduce your taxable income, but tax credit directly reduce the taxes you pay. Okay, so that's the difference between the deduction and the tax credits. Let me know if you have any questions, because sometimes it can be a little bit confusing. Okay, remember, deductions means reduce the taxable income. Tax credit directly reduce how much tax you pay. Okay, so for investors, also has mortgage interest deduction, and also have building appreciation deduction and business expense deduction, and also tax credits if you're qualified. And however, the 1986 Tax Reform Act of 1986 pretty much wiped out all incentives for individuals to invest in rental housing. So that means that they actually changed the depreciation methods. They also had a few other reforms to make it harder for investors to deduct the taxable income if they have rental properties. This act decreased the investment in multifamily housing and also new construction as well. However, the 1986 did authorize the program. It's called a low-income housing tax credit. And that means if you're gonna intend to develop housing units with a proportion dedicated to low-income housing, and then you may be qualified to receive housing tax credit. And we're going to talk about that later on. Okay, we're going to have one chapter just to introduce low-income housing tax credit. And then the investors, if they have the tax credit, and they can just sell the tax credit to the investors, because some investors, they want to get they want to use their tax credit to pay down their taxes, and also they get incentives by doing so, so they can invest into the tax credit, and then the investment from selling the tax credit can help the developers of low-income housing to develop those LIHTC projects. And another major tax legislation was in 2017 during the Trump administration. So that act permanently reduced corporate tax rate and reduced individual tax rate by 7 years. Okay, so I mean, you're going to reduce taxes. That means you have less tax revenues. That means you don't have as much money to spend on housing programs. That act nearly doubled the standard deduction for taxes, which made it difficult to have itemized deductions. So that means if you own a home, you may not even qualify to deduct the itemized deduction because your itemized deduction may be even lower than the standard deduction. In that way, you definitely want to choose the higher standard deduction compared to the itemized lower deduction, because in that way you can reduce your tax liabilities. So that means the doubling of the standard deduction for taxes cut their value and mortgage interest deductions, and also property tax as well. So that means it could diminish tax benefits of owning a home, which could make it happier for a happy scheme for renters, because renters before, they feel like, oh, we don't get any tax deductions because we cannot deduct mortgage interest, we cannot deduct property tax, and it's unfair. But the Tax Cuts and Jobs Act of 2017 made the situation a little bit more fair compared to owners, for renters, because the benefits of owning homes have diminished because everybody get almost double the standard deduction regardless you own a home or not. So this is another major act in tax. And the pre and post Tax Cut and Jobs Act 2017, you can see from this chart, for the tax expenditure and mortgage interest deduction actually decreased drastically. However, the decreases, that means the federal government did not have to pay as much, but because the standard deduction increased, and also because the tax rate was cut. So that means the federal tax revenue still decreased regardless, they spend less in mortgage interest deduction and the property tax deduction. So we had a few lectures in this unit covering mortgage basics and also the housing finance and also taxes. And basically, you should understand that the federal government played important roles in housing finance, and also housing finance played a very important role in the health of the housing market. And also, you should know that federal government had to spend a large amount of incentives and taxes to homeowners and also investors through tax deductions, exclusions, and tax credits. And 85% went to homeowners. So that means homeowners still benefit. However, the 2017 Act reduced their benefits of owning a home, because the deduction for mortgage interest and property tax pretty much is not applicable for a lot of people. And in that way, they just use the standard deduction for everybody, regardless you are homeowners or renters. Okay, so those are the lectures. Let me know if you have any questions. And again, if you have any questions, please email me at yli22@fau.edu.